Hey everybody, welcome back to the Investing Circle, where we talk all things financial independence and making your money work for you. I'm sure everybody's already seen this, but the stock market is technically down. We are in a bear market. So today we're talking about how to invest in the stock market when it's down. Now, if you've been looking for ways that you can take advantage of the stock market when it's down, this video is definitely for you. The last thing you want to do is to put all of your eggs in one basket, and that's why diversifying your portfolio with a few different products that are based on different industries and sectors is so highly recommended. You'll be able to see what works for you and what doesn't, and then make changes accordingly without losing every single dollar you've worked hard to earn. Step one, in our opinion, is to talk to your advisor. Your advisor can help you create a plan which will help you diversify your portfolio and set up a plan of action for investing in the stock market. It's hard to know what to do with your money all the time. That's why you need a financial advisor in some cases, and that's someone who can give you very valuable insight into what you should be doing with your money to reach your financial goals, but they don't offer that advice for free. The typical advisor charges clients 1% of the assets that they manage. However, rates typically decrease the more money you invest with them. My personal opinion as the founder here is I don't think you actually need an advisor to take 1% of your retirement fund to actually make good decisions. I think you can definitely do a lot of research on your own. I think you can look into investing into ETFs and mutual funds, which we will be talking about in a second, that track the market. And there's something like 90%, and I'll try to find this research for you, but 90% of advisors and mutual fund managers that actually charge you this amount of money don't actually beat the market. So why are you going to be paying somebody like that? I'm actually more of a fan of a wealth advisor when you get to that point, like Frank Garcia, who I'll actually link his website in the description below. He's also written articles that we have on the site where he actually charges a fee or a retainer for time spent with him, which means he's providing advice outside of this 1% charge on assets. So get some kind of advice from somebody who knows what they're doing, but also be careful with what you're being charged. Step two here is accept the stock market will have negative years. The stock market can be volatile, and that's normal. It's easy to think of the stock market as a high-stakes casino game where fortunes are won and lost in an instant. Now, this may be a little more tied to cryptocurrency, for example, and I think that's extreme volatility. There are stocks that are a little less volatile, and that's just part of you doing your research. The fact is that there are plenty of times when the stock market had negative years and even decades over its history. Many more periods where it was positive for long stretches of time. The important thing to remember about investing isn't just that you can make money if you pick the right stocks at the right time. It's that even when things go wrong, you're still taking part in one of humanity's greatest endeavors. Investing your hard-earned money so that you can improve your family's prospects for generations to come. So don't fret when the stock market makes a negative move, just keep going. Step number 3 here ties exactly to that, and that's rebalancing. If you have a target allocation that's not being met, it's time to rebalance. Sometimes the advisors that I mentioned earlier in this video help out with this rebalancing, but if you're doing this on your own, you have a self-managed brokerage, you can do this yourself. First, you want to look at the allocation of your portfolio in percentages and see if it needs adjustments. A lot of people will have a certain percentage in ETFs versus individual dividend stocks. This all comes down to what you want. I've also seen a lot of stocks versus bonds, and that's something a lot of people talk about in terms of bonds being less risky than the stock market, but the return is lower. If the allocations are close to what they were initially, it might be best not to change anything. If anything, consider adjusting how much of each investment is represented in your portfolio as a whole versus each individual investment account. If your original allocation, say 70% stocks and 30% bonds, has shifted significantly over time due to market conditions or other factors, say 60% stocks and 40% bonds, then now would be an ideal time to rebalance back towards the original target allocation by selling off some of those more volatile investments and reinvesting in less risky ones. Keep in mind, this is also going to impact those long-term or short-term capital gains, which you want to really get in and talk with your CPA, or at least understand the tax implications of that. Step number 4 here is take advantage of dollar cost averaging. Dollar cost averaging is a way to buy a fixed dollar amount of a particular investment on a regular schedule, no matter what the share price. It's an excellent way to invest, particularly when the market is volatile or you don't know when or if it will rebound. When you sign up for dollar cost averaging, your brokerage automatically invests money from your account into the same investment on a regular schedule. For example, once per month or twice per quarter. A lot of the times, if this is a self-managed brokerage account, you do have to do this on your own. And I actually personally have a reminder in my phone to invest a certain amount every single Monday in a couple of stocks that I personally want to continue to dollar cost average into. You said how much money should be invested. This is called the investment amount or dollar size. If you want to keep buying more shares at lower prices as they become available throughout the time, then increase the number accordingly as well. Now, there are people who agree with the dollar cost averaging and others that don't really feel that it does impact. I'll provide links on both of those below just so that you can make your own decision on that one. Step number 5 is diversifying your portfolio. When the stock market is down, you may be tempted to panic and sell all of your investments, but this is not a good idea. It's better to diversify your portfolio. Why? Because diversification reduces risk by spreading it across several different types of assets. Instead of investing all your money in just one kind of investment like stocks, you can also invest some of it in other types of assets like bonds or real estate. The greater the diversity among these investments, the less risky they are as a whole. This is especially important to bring up if they are not directly correlated. The best way to diversify is by investing in multiple asset classes, for example, both stocks and bonds, and then again with each asset class by purchasing different mutual funds or exchange traded funds. Step number 6, only invest what you can afford to lose. This is a really important one, especially as the stock market is declining and cash is important to have on hand for emergencies. Investing is one of the best ways to build wealth, but it also can be a risky venture. Not only can you lose money, but you can also lose sleep if you are diving into really risky stocks. If you're new to investing and don't have a lot of experience with it, start small and invest only what you can afford to lose. If something goes wrong and you lose your job or some other unexpected thing happens, those emergencies that I'm talking about, it's good to know that there's a safety net underneath you. The last thing anyone wants is to be homeless because they were investing everything they had into something that didn't work out. I'm looking at you, people who invested in GameStop at the very top. Step 7. Look for opportunities. As a value investor, you would be looking for companies with low stock prices relative to their earnings or book value. If you're investing in a growth company, the value of your investment will probably increase over time as it grows into its valuation. You'll want to avoid companies that are facing problems or have too much debt. A company's financials should also be transparent so that you can see how they've performed in the past and predict how they'll perform in the future. There are a lot of good places to figure out the best way to identify a good stock. I really enjoy Seeking Alpha. I really enjoy Breakout Investors, and of course our site, theinvestingcircle.com. Step 8, maximize your retirement investment. The best way to invest in the stock market when it's down is to make sure that you are maximizing your retirement investment. It's never too late to start making a contribution, but starting now will give you many years of compound growth of your money and help you ensure that you reach your financial goals. Make sure that you're taking full advantage of the employer matching contributions and other tax advantages by contributing enough money each year so that all available matching funds are used up before the end of the tax year. If possible, try not to withdraw any funds from this account until after age 59 and a half. This is when most early withdrawal penalties go away. Finally, there will always be a time when the market is down, which is exactly why you should take advantage of it, giving yourself opportunities to invest and having an advisor you trust. It's especially important for those who are about to or already in retirement because it allows them to expand their portfolio and get more returns from their investments. While taking advantage of this situation may seem risky at first glance, there are several things that can be done in order to ensure success, like diversifying your portfolio or reallocating the funds from other investment vehicles into equities. And if you have any strategies that worked for you in the stock market, leave a comment below. Thanks again for watching, everybody. If you liked this video, go ahead and like the content, and of course subscribe to theinvestingcircle.com. If you'd like to find more content like this, please check out our site and the community that we are building. If you got any ideas on what kind of content you'd like to see on this channel, please leave a comment in the comment section below, and I hope y'all have a great rest of your week. See ya.